What exactly is a balance sheet? Why do we need the balance sheet? What are the general terms used, etc. So today will be an introductory session for the balance sheet. And then next week we'll look at the balance sheet of an actual company. So that will be the objective of the next two classes. And then after that, we'll also look at the cash flow statement in the same way. Right. So we had looked at the income statement in the same way. We once for one session we did an introduction, and then in the next session we looked at an actual company, and we'll do the same thing for the balance sheet as well. So before we actually look at the balance sheet of the company, let's understand the need for a balance sheet and understand it in a relatively simple manner. Right. So let's say there is an individual, Mr. A. Okay. So this Mr. A has an income of, let's say, 1 crore per year. Last year, he had an income of 1 crore last year, and he had an income of 1 crore the year before last. Okay. Now let's say there is Mr. B. So Mr. B had an income of, let's say, 5 lakhs last year and 5 lakhs the year before last. Okay. So just by looking at this income, just by looking at these incomes, we will say that that this individual A is actually much wealthier than this individual B, and we will draw all sorts of projections like that. So I mean, when we look at the job market and we look at, okay, this person is earning so much salary, that person is earning so much salary, that's typically how it is spoken of, and then they equate salary to wealth and net worth indirectly. But now let us extend the scenario. All right. Now let us say that Mr. A, actually before his current income, he was involved in a business. Okay. He took a loan of say 15 crores for that business, and that business failed. So now Mr. A has to repay that 15 crores. Now he started a new venture, a new business, and that has earned him income of 1 crore and 1 crore. So then what does Mr. A have? He has a loan of minus of 15 crores, right? And therefore, Mr. A's net worth, just considering at the end of the year, Mr. A's net worth is minus 15 crore and then this 2 crore of income. Okay, he doesn't have anything else. For the purposes of discussion, he doesn't have anything else. Okay. So this individual who is supposed to have had a very, very good salary, when we just look at the salary, actually has a huge loan of 15 crore and everything else, all assets sold, but still 15 crore repayment pending. So he's liquidated everything. He sold his house, he sold everything, but still this 15 crore of repayment is pending. Okay. He earned 1 crore here, he earned 1 crore here. Let's say he used all the 1 crore to repay the loan. Okay. His personal expense and personal living expense was through some other means, through his spouse or through his family's help. So then this individual, just when we looked at this information, this individual looked to be in a really great financial condition. But now when we add this information also over here, we see that this individual, Mr. A, actually is in a very bad shape, right? If his business does not, if he does not, if he is not able to repay these loans and if he does not continue earning a good amount, then his future is not very bright. Now let's take Mr. B. Okay. So this individual B doesn't have any loan, right? He already inherited assets worth 15 crores and he has enough money to live. And therefore, this person is now just doing whatever he likes as a hobby and as a passion. And because of that, this person is just earning 5 lakhs a year. Okay. So when we did not look at this information, when we did not look at this information and we only saw this, this gave us a picture saying that this individual A is actually much better off than this individual B. But then when we bring in this information also in terms of what are his assets and liabilities, we actually see that this individual B is actually in much better shape than this individual A, right? So we have not yet gone to a company. We are looking at the assets from a personal perspective, from the perspective of an individual. And we see here that income only gives us one part of it. But what are the assets that the person has? What are the liabilities that the person has? That gives us a much better picture of the financial condition of that person, right? So let's take another similar scenario. So you go to the house of Mr. XYZ, okay? And then you go to the house of Mr. XYZ, and then Mr. XYZ has a really nice, great bungalow, a very good house that is worth approximately 10 crore. Okay. So then when we go to this individual's house and we look at it, we think, oh, this individual is going to be very rich. He must be, earning a huge amount. He's doing great and so on and so forth. But behind the scenes, what we don't know, because each person's financial status, what loan he has and all, we as laymen may not get access to all that information. But let's say that in this case, Mr. XYZ actually has a loan, okay, has actually taken a loan of approximately 9 crore. So in this case, we find that while his house is worth 10 crore, he actually has a loan of 9 crore to sponsor this house. And let's say this individual has a reasonably decent income, some 30-40 lakhs. Then we find that this individual has actually bought a house well beyond his means. Okay. And therefore, once we get access to this information, we get a better perspective of the actual situation of this individual, Mr. XYZ. Right. So the point that we are trying to make is that just looking at an income statement gives us partial information about about the situation and status of that company in that given year, in those given few years. So when we went to the income statement of uh, different companies, let's just say we look at this company, IndiaMart Intermesh, and then we look at the P&L. This gives us the financial performance of that company for each year, right? But this does not give us the overall state of the company's health. What is the company's health, right? Does the company have some great loan? We have some idea from this statement here, interest, or does the company have other problems? We get that understanding only through the second financial statement, which is the balance sheet. And then we'll also understand the need for the third financial statement, which is the cash flow statement. And together, these three statements gives an end-to-end perspective and picture in terms of how the company is doing. So we try to understand the concept by looking at the individual, right? And we said, okay, just the income does not give us a true picture. The assets and liabilities gives us a much better picture of each person's financial status. In the same way, the assets and liabilities of a given company gives us a much better picture of the status of that company. So today what we'll be doing now is we'll be looking at what are the components that any company has, right, in its balance sheet. But before we do that, let's understand one thing over here. Now, this individual, so each individual has some assets, okay? And that is this house. This is an asset. All right, let's forget the income for now. That is this house. This is the asset. And then the loan is the liabilities. Assets are what I have, liabilities are what I owe. So for Mr. XYZ, 10 crore is his assets, and then 9 crore are the liabilities. So then what is this individual's net worth? This individual's net worth is nothing but assets minus liabilities. 10 minus 9, which is 1 crore. Okay. So therefore, in any financial statement, when we look at the balance sheet, the fundamental equation that we always have to remember is assets minus liabilities equals equity. And this holds true for a company as well. So if there is a company, which has property, plant, equipment, and whatnot for about 100 crore for the purposes of the discussion. But the company also has a repayment of some 95 crore, for example. Then let's say tomorrow the company gets dissolved for whatever reason. Then the shareholders will get what is left over, right? Whatever are the assets minus liabilities, that is the remaining amount, which is the equity. That is what the remaining shareholders will get. Okay. So in the context of the balance sheet, we always need to remember assets minus liabilities equals equity, and we need to always keep this in mind. So whenever in accounting, they draw the balance sheet, etc., and then they always have to match and ensure that whatever they have on the assets and is equal to the liabilities plus the equity part of it. So this matching, etc., is part of the preparation of the financial statements. We are not getting into that, but this is something we always need to remember. So with that being said, let's look at what are the key aspects of the balance sheet. So today we'll just be going through the key terms and we'll look at a sample balance sheet. So the first thing is a balance sheet is a core financial statement used to report their financial position at a given point of time. So this is another key difference between the income statement and the balance sheet. So now when we look at the income statement, and this income statement says March 2024, right? Profit and loss March 2024. Then this basically means the statement of income and loss from the period of, let's just remove all this. So the income from the period of April 1, 2023 to March 31, 2024. So the income statement is given over a period of time. This income statement may be over a quarter, which is a period of 3 months. That's why we have the quarterly results. And in the quarterly results, you see, we have the income statement. Or it may be typically over a period of year. These are the two time frames that are used for the income statement. But when we look at the balance sheet, when they present the balance sheet over here, so when we see this balance sheet as on March 2024, for example, right? The balance sheet is typically as on that particular date. So at the end of March 30, towards the close of March 31, 2024. So this is one of the key differences between the income statement and the balance sheet. The income statement is continuous, measured over a period of time. Balance sheet is measured as on that particular date. So as on this date, what are the assets that the company has? What are the liabilities that the company has? And what is the financial position of the company? So it provides a snapshot of what the company owes, and the equity held by its owners. So it gives you the snapshot as on that particular date. So whenever we look at these things, we need to be very, very clear. This is over a period of time. This is the snapshot at a given point of time on the last day of the March of that year, during the close of the financial year, at the close of the financial year. Okay. So we were looking at the key aspects, assets, and then we were looking at liabilities. Assets are the resources that the company has or the individual has, in the case of the individual. And in the case of the balance sheet, assets are basically divided into two types when we draw the balance sheet. One is current assets and the other is non-current assets. So current assets are assets that are, you can say, that are expected to be converted or that can be easily converted into cash, or it can be sold or consumed within 1 year of the company's, within 1 year. Okay, or We'll just keep it as 1 year for the purposes of discussion. We'll not complicate it. So typically it is taken as 1 year. So what does that mean? That means that, let's say, for example, I have a factory. Okay. The company has a factory. Now, tomorrow, the company cannot convert this factory into cash to run the organization. But current assets, for example, can be easily converted into cash or can be used to run the day-to-day operations of the organization. So, for example, let's say that there is a restaurant. Okay, there is a hotel. So the hotel typically, a restaurant typically has it has tables, chairs, and so on, the decor, the decoration, and so on. Right? For the purposes of discussion, let's just keep tables and chairs. But at the same time, the hotel requires raw materials. It requires vegetables, grains, meat, and so on. Right? Eggs and so on. Okay. So for some reason, because of certain issue, the hotel doesn't have cash to pay for vegetable, grain, and eggs. It doesn't have cash, but it needs these vegetable, grains, and eggs to buy that to run the hotel. It needs to buy it to run the hotel. Now the hotel cannot typically sell its table and chair and say and immediately say, hey, I will convert this to cash and then and then I will run the hotel. That doesn't work. So these are the non-current long-term assets, typically the tables, chairs, etc. Whereas current assets are assets that can easily be converted into cash. And in the case of running that organization on a day-to-day basis, the current assets are usually more helpful from that perspective. So current assets are basically cash and cash equivalents, right? The most liquid form of assets. Typically, they may have cash or most of the time they will have it in some bank account, etc. Then there is accounts receivable. So let's say we are running a tea stall, just as a simple example, and some person X comes and buys some teas and some snacks from our stall. And this person's X says, I don't have money today, I'll pay it to you tomorrow. And this individual is a long-term customer. So we know as a shop owner, we know that this individual will pay it to us in 1 or 2 days, and therefore such amount is mentioned in accounts receivable. The risk, as we all know, is that sometimes if the accounts receivable is not paid, then we will have to record that as an amount that is not paid and as a loss. Then inventory. Inventory are goods that are held for sale in the normal course of the business. So typically so inventory can be classified into raw materials, work in progress, finished goods, and all of that. But typically, inventory can be easily converted into cash as compared to something like a factory or a property, plant, and equipment. And hence, inventory is also stored as part of the current assets. Then there are prepaid expenses. So, for example, let's say I have paid rent to for a particular location. I've paid advance rent of say 6 months when I'm running my hotel. Then this advance rent that has been paid for 6 months, that is also an asset that I have. I don't have to pay anything more in the next 6 months to run that hotel. I've paid that rent for that location. So these prepaid expenses are also part of the current assets. Okay. So typically current assets are assets that can be converted into cash or consumed within 1 year. It's basically assets from a shorter term perspective. That's how we typically look at it. The second thing is non-current assets or longer term assets. And these are assets that will be held for more than 1 year, or it cannot be easily converted into cash as compared to current assets. So the first thing is property, plant, and equipment. So if I want to sell my machinery or if I want to sell my factory, that typically I cannot convert it to cash immediately. I mean, we can sell it, but the fact of the matter is that non-current assets are typically assets that are fixed. And in the course of running my business, you rarely find a business that will sell its factory and then create cash. No, factories are used for producing more goods, and these goods are what bring the business money. And these assets are usually held for several years, several decades, and there is a longer term view for these non-current assets. Similarly, we have intangible assets. So intangible assets may involve assets like patents, trademarks, etc. So if we look at the logo, right, we have the logo of, let's say, Pepsi or Coca-Cola. Now, just the logo or that brand name, that is not something tangible. It is not like some physical property, like it's not a house that I can buy, or it's not a land that I can buy. Yet, Pepsi and Coca-Cola has a lot of brand value and recall and credibility in the minds of people. So these are typically intangible assets. So if we look at, let's just see this Pepsi brand. So So we can see here the brand value of the Pepsi brand has been calculated, and then this is the kind of brand that it has. And they are actually assigning a certain financial value. You may disagree with the financial value. There are ways to uh, calculate it and so on. And these are all approximations. We cannot be 100% sure. But any particular trademark, any particular intangible asset, there will be a calculation for that. For the value of that, and then with time that value of that calculation the value can change, just as the value of a share price changes or the value of any other asset like house, etc. changes. This also changes. And then we may have long-term investments. So for example, the company has some long-term bonds or long-term fixed deposit, etc. And these are long-term investments that the company has, and those are also part of non-current assets. Then we have liabilities. Liabilities are the company's obligations, what is owed to others. And there are current liabilities. So current liabilities can include current liabilities. Again, these are short term. So the current means it's a short term perspective. And they are basically, we have accounts payable, for example. And let's say, for example, that we buy some equipment for running our business, right? We may purchase that equipment, but we may pay over the next few months or cycles, etc. So if we were to buy, let's say, a phone, a mobile phone, we find options in EMI, in Flipkart, Amazon, etc. that says pay via EMI, and then every month we can pay an EMI of a certain amount. So in that case, that becomes the account payable. So tomorrow, if I buy a phone and if I decide to pay that amount in every month, I can have the phone immediately within the next 1 week, 10 days, etc. But that amount, so the asset will be the phone. In the case, in case I buy that phone, the asset will be the actual mobile phone, and the liabilities will be the payment owed. Will be the payment that is to be made, right? And therefore, the equity or the net worth is nothing but asset minus liability, mobile phone minus the payment of the phone, which comes down to zero. So the accounts payable are nothing but payments that I have to make over a period of time. The company has to make over a period of time. So a lot of times company will buy some equipment, will buy some raw material, etc. on credit, and then it will pay the suppliers, say within 3 months. They'll have agreements that payment will happen within 1 month, within 3 months, and so on and so forth. Then we have short-term loans. So short-term loans are debt obligations that are due within 1 year. So if you take a small loan and then you say I'll pay it every month over the next, say, 3 to 6 months, the companies also do that sometimes. And these are basically the short-term loans. And then we have what are known as accrued expenses. So let's say we are all working for a private organization. we get our salary on the last day of the month, typically, or the first day of the next month. So during that month, so in the first 20, 25, 30 days while we work in that organization, we have actually provided our services to the company. The company owes us, the employee, a financial amount, right? Which is our salary. So the expenses that have been incurred, so the company has incurred these expenses, but it has not yet paid them. Those are known as accrued expenses. And then we have non-current liabilities. Again, non-current is nothing but long-term. Current is short-term, non-current is long-term. Same thing with assets. Current and non-current are basically short-term and long-term. And these are basically liabilities that can last beyond a year. So for example, if a company takes typically companies may take a significant debt when they try to set up a new factory. And then they will take a period of 5 years or some 7 years and so on to repay that debt. So this is typically a long-term debt. And then sometimes we have other things. So we can have a lot of different additional things over here. But I have just mentioned some of the main things so that we are at least introduced to the concept and we start getting comfortable. But when we go to the actual balance sheet of an organization, we'll find more complexity and a lot more terms over here. So for example, deferred tax liabilities. So there may be a situation where the company may not pay the tax this year, but may choose to pay that tax, say 1 or 2 years later, along with interest and so on and so forth. So that way these are deferred tax liabilities. There may also be the opposite case. So there may be a case where the company pays advance tax. So in that case, that advance tax, instead of having that cash, that advance tax actually becomes an asset. And then we have shareholders' equity. So typically equity is the owner's claim on the company's assets. And what are the assets that the company has? So the first thing is the share capital. So typically the owner, uh, an owner who starts a company, he will say, so let's just take an example. So there is this company one, company ABC. And then we see owner on the year one. Let's just take the year one. The owner basically puts in his own money of 10 crores. Now, based on the operations of that year, so year zero at the start of the business, the owner puts in 10 crores. Then at the end of the first year of operations, basically the company has made, let's just take, for example, a profit of 1 crore. So then the owner's equity, and this is after everything, right? In the income statement, when we go to the income statement, we will find the net profit, and let's say the company has made a net profit of 1 crore. Okay, and then at the end of the first year. Then at the end of the second year, the company has again made, let's say the company's operations are improving, so it's made a profit of 2 crores and so on and so forth. So each year, right, what is the actual equity that the share that is owned? So initially the shareholder has put in 10 crores, the owner has put in 10 crore, and now the owner has a stake of 10 plus 1, which is 11 crore in the company. The owner now has a stake of 10 plus 3, which is 13 crore in the company. So as and when a company is becoming more and more profitable, the value of the shareholders, the value of the amount held by the shareholders basically keeps increasing. And that is why when we were talking about the income statement, one of the key things that we had discussed was that we typically look at companies that are profitable over several years. So when we look at a company like this, I take this as a simple example, or we see that year on year, the company has continuously been making profits and it's continuously been making increasing profits. And therefore reserves, this is actually the amount. So equity capital is the initial capital that the owners put into the while starting the organization. And then reserves is the additional cash, which is part of the owner's shareholding. And we can see that as the company is making more and more profits, the reserves of the company also keeps going up and up. So share capital is the value of the initial amount, the value of the shares that has been issued by the company. And this is the book value. This is not the money that is in the market. So we'll talk about that separately. Then we have retained earnings. So the profits that the company has earned over time, we have seen that in retained earnings. And then other comprehensive income, for example, unrealized gains, losses, etc. on certain investments. But we'll keep this aside for now. Now, one thing we need to understand is that the share capital that is recorded on the books of the company is not the shares value that is stored over here, right? So the share price that is actually traded in the market typically is much higher than the book value per share. The book value is nothing but the value of the share as per the balance sheet. So when we do assets minus liabilities, we get equity. So assets minus liabilities equals equity. And this equity, let's say there are 10,000 shareholders, 10,000 shares. And therefore, this equity per share gets divided. So the equity, let's call the initial equity as X. So let's say the company had an equity of this assets minus liability, the equity is, let's say, 100 crores, for example. And then we have 10,000 shares. So the equity per share is 0.01 crores. That is the equity per share, 100 by 10,000. But this equity per share is known as the book value. We see here, this is the book value per share. But this same share gets traded in the market typically at much higher values. And that is why, especially for profitable companies, because the expectation is that this company is going to make a lot more money and it is worth much more. So when we look at this equity and we look at the share that is held by the owner, then we should look at this book value. So tomorrow, if for some reason, if Asian Paints is dissolved, then each shareholder will get some amount approximating this, right? Approximately 195, 200 rupees per share. If the person has 100 shares, then that will be 200 into 100, about 20,000 rupees. So these are the typical terms that are used in the balance sheet. And with the help of these terms, we get an understanding of what is the company's financial position. So now we will just look at a simple balance sheet, and typically a balance sheet is shown in this way. They start with the assets. They will show the assets. What are the cash? What are the cash equivalents? What are the accounts receivable? Now, all of these are hypothetical values. We don't have to look at what value is higher, what value is low, and so on. These are all extremely hypothetical values. Then we look at inventory, we look at what are prepaid expenses, and then we say these are the total current assets. Then there are non-current assets, and non-current assets, out of the non-current assets, typically the highest is the property, plant and equipment, all the factories and other things. There will typically be some intangible as brand value and so on. And then there'll be some long-term investments. And these are the total non-current assets. The sum of the current assets and the non-current assets will be the total assets. And then we have the liabilities where we have the accounts payable. We have whatever is the short-term debt. We have accrued expenses. And with that, we have the total current liabilities, the amount that is owed right now. And over here, one key thing we see is that the current assets is about $130,000. but the current liabilities is only $40,000. So what does that mean? That means that the company can service its current liabilities using its current assets. So if let's say I have current assets of, let's say I have cash in the bank. I have cash in the bank worth rupees 10,000. Okay. But I bought a phone and the EMI that I have to pay in the next 3 months, for example, is rupees 5,000. So in this case, I have cash in the bank that is 10,000. The EMI is only worth 5,000. And therefore, this is something that I will be easily able to pay because I have this amount of cash in the bank. It's much more than this EMI. But let's take a second scenario where the EMI that is actually owed, instead of buying a simple normal phone, the person bought an expensive iPhone, for example, and bought it on EMI. So in this case, instead of 5,000, the EMI can go to say 1 lakh or 1.5 lakhs roughly, or 70,000, whatever that number may be. It will be a significantly higher number. So in this case, the current assets of the person is actually 10,000, but the current liabilities is much more than the current assets. It's 1 lakh. So with the current asset, the person cannot service the liability. The person has to look at some other sources from which to raise that money. The person may take debt, the person may sell some long-term assets and so on. So in this example that we saw, the current assets are actually much more than the current liabilities, and that is typically a positive thing in any balance sheet. Now we look at non-current liabilities, and then we have long-term debt, and then we have deferred tax liabilities. We've seen what is long-term debt, and therefore we have total non-current liabilities, which is 110,000, and then we have a total liabilities of $150,000. And then we have initial share capital is some 1.5 lakhs, and then retained earnings. The year-on-year profit is about 80,000, and then some other income that they have earned is about 20,000. So the total shareholder equity is about 250,000. So one of the key things that we look at in our personal life, one of the key things we look at is we should not get into a debt trap. And any company which gets into a debt trap can also get into equal trouble. So we know the names of some big and famous people who are now whose names are now in tatters and whose companies have all been has crashed and so on, and who have gone to other countries. Now, if we read their cases, I'm not going to take any particular name, but if we read their cases, we'll find that some of them, many or most of the cases, there was a situation where they took a huge debt and they were not able to repay. Of course, some cases there are frauds and other things, but one of the key things we'll find is that they are able to they took a lot of debt and they are not able to repay that debt. And therefore the company collapses. So therefore, one of the key things we should look at is total current assets should be more than total current liabilities. And then the debt, we look at other things like debt to equity. What is the total debt that the company has? How much is that compared to the equity? Then we look at, and then we will look at other things such as the repayment of the debt on a monthly, how easily can the debt be repaid? So another key thing I typically look at is debt to profit. So if the company has a small debt, then it can pay. So if we look at the net profit over here, if the company has a debt of, let's say, where do we have? So we have some borrowings and then we have liabilities, etc. So typically, if a company has debt that can easily be paid with its yearly earnings, with the last year's yearly earnings, then that's a very positive sign. So typically, I will look at measures like a debt to profit. I will look at a debt to equity. And the key thing that we look at is what is the kind of debt that the company has. Then another thing that we look at, I think it is not mentioned over here, but another thing that we look at is capital work in progress. So we have property, plant and equipment, but we can also have something that is capital work in progress. So the company is actually building new equipment. It is building a new factory. So that is not yet property, plant and equipment that is generating income. That is often shown as a in a separate line item. So that is also something we typically look at from a balance sheet perspective. So if a company, it's the CWIP, if a company is building more and more and more assets, right? If there is more capital work in progress, it means the company is expecting more business in future, or it has solid reason to think that, that there will be more demand. We need to make more of the product and we need to sell more of the product. So that is why the owners, after having considered these extraneous factors, typically the owners will start bringing up new, uh, plant, property, equipment, buildings, etc. So this is another thing we look at. So we see here, this company is, I think, Asian Paints. Okay. So if we look at Asian Paints, we see that every year the capital work in progress has typically been increasing on average. Okay, some years it's gone down, but typically there's a significant amount of capital work in progress. And therefore, we see that the business of Asian Paints is expanding. So as the capital work in progress is positive, we typically see that the net profit also of the company is on a year-on-year basis, on average, increasing. That's because as they are building more and more capital, as they are building more and more plant and equipment and other capital intensive goods, other capital, other factory and so on. As they are building that, then this factory, once it is built, it becomes productive. They start producing the paint and then they sell the paint. And because they sell the paint, they start making more money. So this is another typical thing we will look at in the CWIP. Right. So this is a very, very basic introduction of the balance sheet. And next week, we'll actually pick up the balance sheet of some organization and we'll go on a line by line basis and look at it and actually look at the details. We'll look at all the notes that are given in the financial statements and so on and understand this in much more detail. So today was just an introduction. So any questions or doubts?
Hi Harish, I wanted to know what will be, I mean, when you're looking at debt to equity ratio, uh, what would be a good debt to equity ratio to decide that the company is going to remain liquid in for the foreseeable future? Like both debt to
So
equity and the, yeah.
See, it typically depends on the nature of the business. So if you look at stock market investors, they'll say a debt to equity ratio of less than 1 is positive, less than 0.75 is decent, and so on. Less than 0.5 is decent, and so on. But there are two things that we need to keep in mind. One, the lower the debt to equity, typically the better, the safer we are. So if we are going to a new business, let's say we are investing in a new business and we don't understand much of the business, we don't understand much of that industry, then one way we'll keep ourselves safe is when we look at organizations which have a lower debt. But the main thing that we also need to do is, as we are reading and learning about the business, we also need to understand where and how the business is taking debt and how it is using that debt. And is that debt safe or not? Right. So if we look at banks, for example, banks typically, what do? They borrow money from all of us. We put our money in banks in the form of a deposit. And then the banks will take that same money, give it out as a loan, and then the bank will make the loan will charge it will charge a higher interest rate in the loan as compared to what we are paid in our deposits, right? So a bank is a business that is typically based on high debt, but we can see that there are many banks in India which are very, very stable, which are growing and which have been doing well year on year. So it depends on the nature of the business, and typically I prefer businesses which have low debt. So less than 0.5, less than debt to equity of less than 0.5, etc. And then I generally play it safe when it comes to debt, because if we go wrong with regard to debt and if the company crashes, then we have lost all our capital. So better safe than sorry. That is my approach. But you will find other people who do invest in companies that have taken high debt, but they have understood the business inside out. They know the risks inside out. They may be big investors who are interacting with the management and so on. And therefore, they may do that and they may still make money. So there is no hard and fast rule. But to be on the safer side, we should always look at a debt to equity ratio that is typically on the lower side, less than 0.5, etc. Does that answer the question?
Yeah, thank you. Yes.
All right, then thank you all. We'll meet next week and we'll continue with the balance sheet. Have a nice week ahead.